Live. Good morning, judges. I'm Narayanan,
And I'm Rashesh Tucker.
and we're here from McNeil High School today to present to you coverage on Halliburton Company, ticker HAL, with a strong buy rating. As of February 2026, HAL trades at $33.52, but our fundamental analysis reveals a 12-month intrinsic value of $45.23, representing a 34.5% upside. The market continues to price Halliburton as a legacy North American service provider, but now, with new technological jumps and structural changes, we see that as a fundamental misclassification. Our research, conducted entirely independently using publicly available data and an objective analyst perspective, is now ready to present to you why Halliburton is a strong buy.
Our conviction rests upon the shoulders of three newly defined pillars that differentiate Halliburton from its competitors. First, the autonomous powerhouse. Halliburton has moved from providing manual labor to providing automated software solutions powered by artificial intelligence. Zeus IQ is not just an improvement, it is the industry's only commercially operational, fully autonomous, closed loop hydraulic fracturing system. With a 2+ year technology lead, they are setting a new standard for operational efficiency. Two, structural cash resilience. Halliburton is truly a cash cow masquerading as an industrial. The company boasts a 9.2% FCF yield, which is a staggering 220 basis points above the peer median. This cash is supported by a defensive 0.78 beta, indicating significantly lower volatility than the broader market. Three, global de-risking via NOC partnerships. The company has aggressively pivoted its revenue mix. Currently, 59% of revenue comes from international sources, largely tied to national oil company contracts. These long cycle commitments act as a structural floor, insulating Halliburton's earnings from the boom and bust cycles of US powered shale.
Now, let's move on to exactly what drives Halliburton to be such a powerhouse, and that lies within its two operating segments. First, there's completion and production. Completion and production represents Halliburton's ability to go deep into the oil system and make all of its money. The segment represents 55% of revenue, approximately 12.2 billion in fiscal year 2025. It's the home of hydraulic fracturing, cementing, and simulation. It's a high margin business currently operating at around 16.4% margin. It's further supported by its drilling and evaluation business. Accounting for around 45% of revenue, or $10 billion, this segment provides the eyes and ears of the well through logging while drilling, LWD, and wireline services of Halliburton. D&E is the primary beneficiary of Halliburton's international offshore growth and maintains a healthy 15% margin. This brings us to a key insight. Halliburton's margins and its production value separates it as a cut above all of its competitors. As the geographic mix shifts, North America sees cyclical softness, but Latin America, the Middle East, and Asia, all countries where Halliburton is deployed heavily, are growing. These markets are anchored by massive multi-year contracts with entities like Saudi Aramco and ADNOC, and we project international revenue will reach 62 to 65% by fiscal year 2027, effectively converting Halliburton into a global infrastructure powerhouse.
Halliburton is being ignored by the market despite its truly superior fundamentals. Hal trades at an 8.09 EV/EBITDA multiple, which is a 12% discount relative to the peer median of 9.2. This discount exists despite Hal having the highest FCF yield of 9.2% within its peer group. We've developed a proprietary scorecard to benchmark HAL against Schlumberger and Baker Hughes. Across North American technology, international footprint, and FCF generation, Halliburton earned a composite score of 22/25, surpassing Schlumberger's 20/25. In conclusion, Halliburton is a best-in-class performer, trading at a bottom-of-the-barrel multiple.
Now, let's move on to Halliburton's key algorithmic moat, that being Zeus IQ. The centerpiece of Halliburton's autonomous revolution, it creates a technical edge where the intensive process of hydraulic fracturing, a manual, human-focused process, is usurped by an ML algorithm that's trained on thousands of previous stages to make real-time autonomous adjustments without human intervention. This creates a clear dichotomy of Zeus IQ versus its competitors, with the software processing 10 terabytes of data instantaneously to optimize pump rates and fluid volumes in a way that Schlumberger just can't. These results are public and profound. Coterra Energy achieves 17% stage efficiency gain using this platform, and major Permian operators achieve full autonomy 2 years ahead of schedule. Beyond fracturing, Halliburton's autonomous stack includes AI like Logix for drilling and iCruise for AI-powered geosteering. This isn't just a service, it's an AI-powered moat that grows wider with every gigabyte of data processed.
Halliburton is uniquely positioned to solve the AI industry's biggest bottleneck, power. Training LLMs requires massive low latency quantities of electricity. Through its partnership with VoltaGrid, Halliburton is deploying 400 megawatts of modular power generation for various AI centers. This is projected to add $200 to $240 million of revenue by 2028, and if Halliburton captures just 1 to 2% of the global AI data center power market, this could become a $2 to $4 billion revenue stream by 2032. This provides a non-oil price dependent growth engine that the market has given zero credit to whatsoever within the current share price. Our target of 45.23 is not a finger in the wind. It is the result of a weighted multi-method valuation. Let's get into the method behind this value. We calculated a WACC of 9%. This is built from the ground up using a risk-free rate of 4.43% and a conservative beta of 0.78. So why does this beta matter? It shows that Halliburton is actually less volatile than the broader market. Now let's take a look at the economic value added. Halliburton's ROIC is 16.2%. When you compare that to our 9.0 cost of capital, it's clear management is nearly doubling their return on every dollar investment. That is the definition of an elite steward of capital.
Now, let's move on to Halliburton's key driver, its powerful FCF machine. With the 5-year model, we forecast significant expansion in Halliburton's cash generation. We have top-line growth in revenue projected to climb from $22.2 billion to $27.808 billion in fiscal year 2029. Furthermore, we have EBITDA margins expanding from 19.4% to 21.5% as higher margin Zeus IQ technology and other AI and international NOC contracts dominate the mix. Furthermore, we can see that Halliburton's cash on hand is king. With an FCF expected to grow from $1.9 billion to $3.6 billion, we have an extraordinary 12.7 FCF return on today's stock price by 2029. And all this brings us to a head, and not only the investment risks, but the ESG and AI considerations that come with it. We have thoroughly stress-tested Halliburton's bear case. We have agreed to a point that with commodity exposure of $50 to $55 of oil is a risk, we can see that Halliburton can respond to that risk. With the company generating $1 billion in free cash flow during 2020, when oil prices were at some of its lowest times, $42, proving that the company has direct structural resilience. Furthermore, the company operates within a geopolitical hedge. With operations in nearly 70 plus countries, we have single country disruptions that could topple any other company become manageable for Halliburton. Finally, we move on to Halliburton's ESG as profit. Looking at the ESG considerations, we can see that Zeus IQ creates an electric fleet that is the largest within North America. It reduces Scope 1 and Scope 2 emissions while providing a 70% fuel cost reduction for the operator, creating a rare metric where ESG considerations, saving the environment and protecting everyone, meet profit. And this profit is only further buffered by Halliburton's AI power, that being Zeus IQ and its other drilling techniques. All of these automations create Halliburton's technological moat and put it a cut above the rest.
In summary, we'd like to reiterate our strong buy on Halliburton. Zeus IQ provides an unmatched AI-powered moat. Structural stability via international NOC revenue insulates Halliburton's bottom line, and elite cash generation at a 12% valuation discount offers a massive margin of safety. The market is pricing a commodity contractor. We are buying the technological leader. It's time to re-rate Halliburton to our target of 45.23. Thank you, and we now welcome your questions.